Hi, I'm Jason Hawkins, founder and president at Lightpath Wealth Advisors. Today I'd like to share with you a recent case that I worked on and how we used an annuity contract to help our client Pam achieve a better rate of return on what she considers to be her safe money, meaning money that she doesn't want to lose. Pam is 64 years old and already a couple of years into her retirement. She's in a good place financially as she's drawing both Social Security and a guaranteed lifetime income from a different annuity contract that we had previously helped her set up. Pam has other investment accounts as well, but one thing that she is really frustrated with is the fact that her bank is paying her little to no interest. Pam consistently keeps a high balance on account at the bank because she's not aware of any other options. Pam's comments to me were that although banks aren't paying much in interest, at least I know that my money is secure. After her comment, I posed this question back to Pam. If I could show you an investment that is guaranteed to never lose money, but offered you the potential of earning between 0% and 15% interest each year, where you could expect a compounded rate of return of somewhere around 5 to 6%, is that something that you would be interested in? And after a brief chuckle, Pam said, absolutely, that's a no-brainer, but does that type of product really exist? My response to her was absolutely. And then I proceeded with educating her on the many benefits of a flexible premium fixed indexed annuity and what she could expect with this type of an investment contract. After a thorough evaluation and many other questions, Pam ultimately ended up moving forward with her contract. We set her up in a product where 100% of her asset allocation was tied to the S&P 500 index, and the particular strategy that we used was a 50% participation rate. So let's take a closer look at Pam's contract in order to help you better understand how this strategy works. Pam's anniversary date is April 5th. Therefore, you take the close price of the S&P 500 as of April 5th, 2016, which was $2,045.17. Then you go out 1 year to April 5th, 2017 to capture the close price of the S&P 500 on that date as well, which was $2,352.95. So during this time frame, the index gained 307.78 points, or said another way, the index was up 15.04%. From there, you simply take the percentage gain and you multiply it by 50%, and that is your credited interest for the year. So in this particular example, Pam was credited 7.52% on her policy anniversary date. Now, the reason I say that she had no risk was because this contract comes with a 0% floor, which means that if the market were to correct and have a down year, instead of losing money, she would simply receive 0% credited interest in that particular year, which is essentially where she started with having her money tied up in her checking account. At least with this product and strategy, there is the opportunity for growth each year. And with the annual reset, you start fresh while locking in profits from the previous year. If you have money parked at your bank and you're not pleased with the rate of return, but have historically left that money put because you're unaware of a better solution, please get in contact with us today. And much like we helped Pam in today's example, we'd love to do the same for you. Most contracts can get started with as little as $5,000 to $10,000. And these contracts can be utilized by investors of all ages. Until next time, this is Jason Hawkins with Lightpath Wealth Advisors, where we help you navigate the retirement journey together.